Hi, I'm Nick Drew with Capital Design Private Wealth, bringing you our May video newsletter. Our past experiences have a huge impact on the way that we expect our current circumstances to play out. I can relate to how hard it's been for many to be patient with the stock market's volatility and negative returns through the first 4 months of this year, without a real clear end in sight. In 2020, we had the shortest recession in our history of about 2 months. After the economy was shut down, the market then soared after trillions of dollars were pumped into the market and the money supply. Now, with the future of the war in Ukraine uncertain, inflation at 40-year highs, and COVID-related lockdowns in parts of China, we may not see the instant gratification of a quick recovery like we did in 2020. Now, it's certainly not all bad news out there, and going back into recession is not a foregone conclusion. Given the uncomfortable volatility that we've been having, it's important to remember that over the last 20 years, 24 of the 25 best days in the market occurred within 1 month of the 25 worst days. It's also an important time to reflect on the things that we can control, like having an updated financial plan and conviction that the risk level and diversification in your portfolio is in line with your short-term needs and long-term plan. If you don't think it is, please reach out to Hilton, Andre, or myself, and we'd be happy to review these details with you. Now, shifting gears, the housing market and what many experienced back in 2008 has also been on a lot of our clients' minds. With mortgage rates on the rise and house prices skyrocketing, many are wondering if we're headed for another crash in the housing market. Ben Carlson, a CFA with Ritholtz Wealth, put out an article a couple of weeks ago that highlighted areas of strength within the housing market and gave 4 reasons why the housing market is unlikely to crash. After 2008, in the financial crisis, many began to believe that housing crashes were normal. Now, of course, anything is possible in the markets, but there are 4 interesting tailwinds that may help support the real estate market. The first is that we have the largest demographic in our country in the prime of starting and growing their families. Millennials will mostly be in their 30s and 40s for the next 10 to 15 years. Millennials did put off settling down for longer than their parents' generation, but a large portion of this demographic now have kids or are having kids and are moving to the suburbs. And that's typically when most people want to buy a house. Millennials are responsible for more than half of all mortgage loan applications in 2021. The next factor with major importance is the lack of housing supply. We simply stopped building enough homes following the housing crisis, after many overextended home builders were caught holding the bag when housing prices fell more than 30%. Carlson notes in his article that there were roughly 210 million people in the U.S. in the early 70s, and we were building about 2 million houses per year. Now, there were 330 million people in the U.S. last year, and we only built 1.3 million homes. The third factor is that very few people want to sell their house, further limiting the availability of inventory. Homeowners will have a hard time giving up their 3% mortgages if they're satisfied with their current home. The final factor is the strength of the consumer balance sheets. At the height of the 2006 housing bubble, about half of borrowers taking out a mortgage had a credit score of less than 720. Today, just 18% of borrowers have a credit score in that range, and over 2/3 of borrowers are above 760 on their credit score. Now, house prices certainly can't continue to go up 20% a year, and the market will slow down eventually. But slowing down is very different than a market crash. Thanks for tuning in, and have a great day.